My name is Ravinder Bhatia, and on behalf of ASK Investment Managers, I welcome you all to ASK Domestic Resurgence Portfolio's quarterly update call. Today, we have with us Mr. Kuldeep Gangwar. Kuldeep has more than 19 years of experience, including more than 16 years of experience in equity markets. This experience includes more than a decade in sell-side equity research. His main domain expertise is in consumer sector, FMCG and retail. Prior to joining ASK, he was associated with HSBC Securities and Capital Markets India Private Limited as a sell-side research analyst. He has also worked with Tata Motors for 3 years. Mr. Gangwar is an MBA Finance from IIT Bombay and BTech Electronics and Communication from IIT Roorkee. He is a CFA charter holder. He joined ASK in January 2018. Today, we have scheduled this webinar wherein I would request Kuldeep to cover the broader trends in the market for 10-15 minutes, followed by a deeper understanding of the ASK Domestic Resurgence Portfolio, giving an insight on what happened till now in financial year 24, where do we stand now, and how we see things going forward. This would be followed by Q&A, question and answers. I would request all of you to type your questions and queries related to the portfolio, and we shall curate and try to get them answered. So, Kuldeep, thank you so much for joining in, and all over to you.
Sure. Thanks, Ravinder, and good afternoon, everyone. Thanks for joining in. So before coming to the portfolio, the context also matter. Like in the global scheme of things, India had been relatively more resilient. So if we think about 1 year, say stock market performance, it was close to 20% for the overall market. On 3 year, 5 year basis, it had been outperforming the rest of the markets. So what we have seen in last 2-3 years, most of the newspaper channels were discussing about, say, inflation and the response of most of the central banks for this inflation. The way we think about it, it was quite a big challenge in 2022, like high single digit, low double digit inflation being observed in most of the developed economies. Which is not the case being experienced for many decades, if I have to say so. And if you think about US per se, they have aspiration to bring down this inflation to close to 2% and so. So when the inflation is there, the central banks increase the interest rate to contain the same. And it's also coming down. And it's already reflecting that in most of the developed economies, now the number is more say low single digit, like 2 to 3% or so. So this is not that big a challenge as we speak. We have seen that commodity prices have come down across the board, whether it's agri commodity, metals, and it's all across, if I have to say so. For India, being the one of the largest importer of the crude oil, the price of the same do matter. So when the Russia-Ukraine war broke out, there was close to $128 per barrel crude oil price in February 22. This number is now close to $80 because the crude oil price movement is driven by, say, marginal demand and supply. So they can't remain, say, at a particular level unless same is suggested by the demand supply equation. And if the overall economy environment is not that great globally, then they have to settle down at a relatively lower number. So after having a spike in September 23, the crude oil prices have again come down. In recent time, there had been, say, resurfacing of challenge of freight cost because of the Red Sea crisis. So it's having some bearing on the export, whether it's happening through India or from any other country. So it's a challenge. It can have some implication for the operating expenses of some of the companies, which are particularly, say, having decent exposure towards, say, rest of the world. But if you compare the same from, say, the freight rate at the peak of the, say, crisis, the number may still look quite relatively lower, though it's almost 3x the jump what probably we used to have in the November 23. So it's a concern, and we have to watch out for this particular thing. More often than not, we have seen that central banks respond to a problem, and the problem was inflation. So they kept on increasing the interest rate. And in case of our own country, interest rate pause happened in the beginning of 2023. In case of years, the pause happened in July 23. In case of European Union, the same happened in September 23. And this is quite important because the interest rate cycles are having implication for the, say, equity markets. So when the inflation is high, interest rates are high, it's not a good news for the overall equity market. And it's even worse for, say, growth sectors, growth stocks, growth economies. So from September 21 till date, we can say the economic environment or say macro environment was not that conducive. So despite the companies were delivering good solid number on ground, the appreciation of the same did not happen because the asking rate had been higher. If people are getting a certain rate in the fixed income, they do ask for a relatively high number. And when the interest rate cycle turn and the interest rates are coming down, so it's a good news for the overall equity and even better news for the, say, growth sectors, growth stock, and the growth style, if I have to say so. Domestic backdrop, like if you look last couple of years, our economy is largely capex driven, and say consumption had been relatively muted. The reasons may be different, like in case of say broad-based consumption, the inflation was a challenge. And in recent times, the discretionary consumption has also taken a beating. But a couple of things may be there. Like in FY23, most of the discretionary companies had very good, solid performance. So making quite high base for many companies in that particular segment. The way we think about it, like in FY24, the normalization is happening and things should start again coming back from FY25 onwards. So this is more about what the government has said in budget, like it's again going to be capex led. If you think about revised estimates of the capex, still we are talking about close to 17% higher allocation in FY24. So this is the spread between, say, US and India 10-year bond yield. We know that India offer relatively higher interest rate, and that is attraction for the somebody who is sitting outside India. But we have seen when the interest rates were rising, it has risen all across, whether it's India, Europe, or say developed market, including US. In recent times, this gap has come down. Like US has increased almost 500 basis point. In our case, the increase had been relatively lower. It also suggests the kind of resilience we are having at local level. CPI or say inflation had been a global challenge, including India, and for us, it had been particularly say more pronounced in case of food CPI. Like if you look overall number, it's trending down close to 5% in January 24. And large part of this can be attributed that the bottom line, like almost 8% food CPI, which is a challenge, if I have to say so. And it had been a relatively volatile number. Otherwise, core CPI, excluding these stuff, had been more manageable. If we think about Q3 FY24 overall delivery, so volume growth was relatively weak, whether it's a consumer discretionary or the export areas. Automotive capex have done relatively better, and pharma continue to drive the growth. So capex-led sectors did relatively better, while the domestic consumption was muted. IT earnings were muted, but more in line with the expectation. Pharma companies reported better than expected numbers, driven by stable volumes on the domestic front. Two-wheeler and passenger vehicle had good volume, good gross margin expansion, higher operating leverage benefit. That's the reason better operating profit. As I mentioned in the beginning, the consumer discretionary volume remained muted because post-festive season, the demand did not pick up to the extent what the most of the people were anticipating. And reason may vary, like it's company to company, but we have seen in the consumer discretionary space, barring jewelry, almost every sector or subsector had the challenge. Whether it's a QSR, footwear, apparel, everybody had one challenge or another. In case of financial sector, there was NIM compression, like net interest margin compression, more on the expected line because the cost of funding has risen. At the same time, say the companies did not raise say lending rate, and when the NIM compression is happening, then say NII growth is relatively lower than the say loan growth over there. Cost to income ratios are relatively higher, and credit costs are normalizing now. That's the reason say PBT growth had been even lower. If we think about BSC 500 overall, so if you look last 3 quarters, top line growth had been low to mid single digit growth. The difference had been that in the first half of the FY24, operating profit growth was close to 30% or so. This number is normalizing, like top line growth and the EBITDA growth is now converging. And in future, we believe that most of the earnings should be driven by the top line growth itself. Consumption sector is big allocation for us. Sector overall delivered close to 15% plus operating profit growth. And there were divergent trends, like a staple delivered muted earnings on the expected line. In certain pockets of the retail, the earnings were decent. In discretionary impersonal, like paints, etc., had relatively stronger earnings. Beverages did relatively quite better, whether it's soft drinks or say alcoholic beverages. Most of them have done remarkably better. QSR, April had their own share of challenges. This is a piece where I will like to say explain relatively more in detail because there are a number of companies coming from this particular area, whether it's a Metro brand, Page Industry, Titan, or it can be Vedant. So first, how the things are progressing. So first half was below, relatively subdued on the expected line. Second half was expected to be better because this time the Diwali was expected to happen predominantly in Q3. So everything related to festive-led demand was supposed to happen in Q3. But across the board, we have seen that the delivery on the ground had been relatively lower than the expectation. So it may look like whether it's a Page, Vedant, everything has done better vis-a-vis say first half FY24. But whatever number they have delivered, it was lower than the initial expectation for the Q3 FY24. And when it happened, it's having implication for the full year growth. Like FY24, if you look any company, whether it's a Page, Vedant Fashion, Metro, the numbers look relatively much lower vis-a-vis say their own history. So if you look the right hand side, there is FY19 to 23 column. Page Industries used to have close to 14% CAGR. For FY24, this number is almost minus 2%. For Vedant, again the 14% CAGR during FY19 to 23. This year it's a 2%. So question comes whether it's a change in pattern or say a change in trend or it's a blip in the overall story. So the way we think about it, like from historical perspective, discretionary consumption is going to have long runway of growth because in any economy, first people serve the basic need. Like if you look this particular slide, India is still is at that particular point where food and grocery almost 68% say retail consumption happen in that particular area. If you compare with say US and China, the relatively lower number goes in this particular area. Where the people spend a lot more, that is more like apparel, accessories, and others. So more discretionary consumption pick as any economy grow. So India should not be very different from that particular, say, prospects perspective. So we have no doubt about, say, strong growth prospect for the discretionary sector overall. And if you look the history of our own country, like in FY22, food and grocery used to be close to 68%. Last year, it came down to 65. And we expect that this number should come down to even lower in next 3-4 years. And apparel, apparel accessories, other stuff should pick in due course of time. So discretionary consumption obviously going to have relatively high share in the overall consumption and much faster growth than the overall retail growth in this particular sector. So long-term growth perspective, we remain quite optimistic about it. And when we say meet the companies and go through their results, so company by company, so Vedant has mentioned that the Q3 was not that great because the wedding days were not that high. And there was high base in Q3 FY23 because bunched up demand in post-COVID scenario. Similar commentary came from Metro, similar commentary came from Go Fashion, and most of these companies suggested that probably Q4 is more of a transition and FY25 the thing should normalize. So currently, the way we think about it, like in the overall scheme of things, FY24 was more of an exception rather than the norm. And we built in almost 20% plus growth in across the large part of the subcategories and most of the companies in FY25, and equally strong growth in FY26 as well. Operating profit growth should be even higher because if we have that sort of scale, that sort of sales growth, the operating leverage benefit should deliver even a stronger number. So from consumer discretionary side, irrespective whether it's a Vedant, Fashion, Metro, and say Page Industries, etc., we believe that from coming year onwards, the earning performance should improve. Infrastructure and engineering sector is again overweight area for us. So we have seen whether it's cement, capital good, manufacturing, they have delivered quite a strong number. And we believe it should continue, like whether it's happening in the area of railways or defense. And even equally important point is like in last 2 years, the capex was led by government, and probably in coming years, it should be private capex. So we believe that from medium to long term perspective, this is the area where a lot of action will be happening, and we are maintaining a significantly higher exposure in this particular area. Automobile sector, quite a strong growth, and whether it had been OEM or auto ancillary, it had been quite robust all across. The reason that the volume growth in combination with gross margin expansion and operating leverage led to this particular delivery. Healthcare sector, say domestic pharma, quite resilient earning growth. International pharma delivered quite a strong growth. So there are certain pockets where the positive surprises had been there. At the same time, in certain sector, the challenges had been there. Financial sector was one of them, like where the names for banks were lower, and it was more on the expected line. And pressure on the NIM may persist for a quarter or two because there's a tight liquidity in the system as we speak. When the NIMs are compressing, then it's having implication on the NII growth. And as I mentioned in the earlier, say, conversation, that say elevated OPEX led to relatively lower operating profit growth. And in the current scheme of things, we believe NBFCs are better placed vis-a-vis banks over there. Now we come to DRP. So there are certain pockets like manufacturing, beverages, staple, telecom, which have delivered quite strong, say, performance in FYTD, FY24. So manufacturing as a pool would have delivered 40% plus, say, stock return, beverages 60% plus, staple 60% plus, and so on. There were certain pockets which have not done well. We have discussed about the consumer discretionary part. Chemical part, we have some minor exposure, but chemical sector is facing the challenge of destocking and relatively muted end user demand. Financials, we have already discussed that across the board, it's a similar sort of situation that NIM compression and liquidity leading to some uncertainty in the near term. As well as another area where we were not present, like PSU, we had no presence at least till November 23. And this is the area which has done quite well in terms of the stock performance. So from BSE 500 perspective, the weight of the PSU would be close to 10%, and they have risen by almost 78% or so. So we did not have much presence in that particular area. In December 23, we introduced a couple of names, like one in defense, one in the BFSI sector. And so we have tried to address this underexposure part partially in last couple of months. At aggregate level, like we believe FY24, there should be 25% plus earning growth, much better than, say, Nifty over there, and it should continue for even FY25 as well. And this is not about this quarter, this is not about FY24. This earning alpha had been there for whether it's FY23 or last 5 years. So At portfolio level, the overall earning growth for the portfolio was close to 26% CAGR at the 5-year interval, with a 16% for Nifty. From psychographic perspective, financials, we have close to 28% weight, and it's all across, whether it's a bank, NBFC, insurance. Consumption, we have overweight beverages. We have both, say, alcoholic beverages, non-alcoholic beverages, and retail staples, and so on. Infrastructure is again a big overweight position for us because we think if the capex had been theme for last 2-3 years, it should continue for at least next 5 to 10 years. So we had quite decent exposure, and in fact, we have increased exposure in this particular area through whether it's a defense name like Bharat Dynamics getting added in December, and say manufacturing name like JSW Infra, etc., getting the place in the portfolio. We also added, say, auto ancillary named C8 in December again, which has also done reasonably well. Pharma was another missing element, so we have included Mankind Pharma in December. So a number of changes were done in recent times, almost 5 changes over there, and we have tried to, say, plug in the white spaces, address the areas where, say, structural growth opportunities are quite visible, and so whether it's a health, automobile, defense, we have tried to have decent exposure in those areas. Aggregate level, EPS growth, we believe about 20% plus, and same should continue in, say, about 25 as well. This is quite important. Like if you look last 4-5 years, so at any given point of time, stock return, portfolio return, a combination of two things, like what is happening to the earning and what is happening to, say, valuation. So in last couple of years, the earning growth had been quite robust, but at the same time, multiple derating was happening because they were concerned related to, say, interest rate, macro challenges, and so on. And that's the reason that the full benefit of the earning growth was not visible. So whatever came from the earning growth, it was lost through the derating of the multiples. But today, as we speak, the multiples are quite close to the bottom being experienced in last 4 years. And this bottom is being experienced during, say, COVID 1 time, COVID 2 time, Russia-Ukraine war time, and so on. So we are quite close to that trough level. And theoretically, if say valuation derating is not happening further, then earnings should translate into the stock return. This is a snapshot of the portfolio performance. So as I mentioned, like a couple of say month had been difficult, especially last 2 months, and which had been dragged on the full year performance. So from full year perspective, it may appear like 32% return vis-a-vis, say, BSE 500 would be having 33%. But it is more driven by the short-term underperformance, which happened on different count. So if you look the detractors in last 3 months, so Polycab, Vedant Fashion, APL Apollo, Bajaj Finance did not do well. If we look the same name from 1 year perspective, so Polycab had been a big contributor to the full year return. Same is the case with many other names over there, like APL Apollo and so on. So we have to take into consideration that if the correction has happened at the time when the companies are still going to deliver strong earning growth, some patience is required. And that's the reason we are going case by case, looking on the individual cases, and where we believe the correction is more pronounced than warranted, we are increasing the weights. Where we believe that, say, uncertainty may sustain, we are bringing down the weight, and so on. So there had been certain challenges in certain pockets, which led to some drag in last 2-3 months. But if you look, say, a longer term, it had been reasonable performance, and we believe that as long as the fundamentals are intact, earning is coming, and if the further derating is not happening, then the future return should be relatively better than what we have experienced in the recent past. I will stop over here and happy to have any question which you might be having.
Thanks, Kuldeep. There is a lot of interest, in fact, building up with multiple questions already been raised. I would request participants to type in your questions and queries related to the portfolio, and we shall curate and try to get them answered. So first question is, Kuldeep, what are the key themes that you are covering under the domestic resurgence strategy?
So, as I mentioned, like consumption and financial had been key overweight for this particular strategy since inception. So, in 2018, when we launched, the consumption and financial put together used to be almost 90% of the portfolio because we always believed in this compounding structural theme. And then the COVID happened, and we believe it was boon in disguise because it changed the say prospects for many sectors. So whether it's infrastructure engineering, say technology, whether it's a chemical sector, and so on. And in recent times, like utilities, etc. So we kept on diversifying our portfolio, try to cover, say, India growth story in as many places as possible. Basic theme is like uh, whichever sectors are going to have faster growth than the underlying economy growth in this country, we want to be there. And so, as I mentioned, if at the time of inception, the financial and consumption used to be close to 90%, currently they are 50%, because we have deployed a lot of, say, portfolio weight in favor of, say, infrastructure engineering and, say, technology platform and so on. So, if I have to say consumption, infrastructure engineering, these are relatively overweight themes. At the rest of the places, like whether it's auto, say chemical, say health, we have taken some exposure in recent times.
Okay. The next question is from participant. Though you have covered briefly, the drag to the performance has been below expectation Q3 FY24 performance from companies in consumer discretionary and BFI space.
Yeah.
Could you please elaborate that from here on, which sectors of the portfolio earnings could be better for next few quarters?
So I try to answer that particular part, like consumer discretionary piece, which is sizable in the overall portfolio. They had drag not only for Q3 performance, if I have to say at aggregate level, the FY24 performance was muted. And I've already shown you that we believe it's blip in the overall story. And probably FY25 onwards, the thing should come back. So whether it's a Metro, Vedant Fashion, Page, we believe the strong earning growth in coming years. Titan has delivered strong earnings in past and should continue for years to come. There were other pockets like Varun Beverages, Redigo Kitan. They are delivering solid earnings and there should not be any let-up. So the way we think about it, like there were certain subcategories under the consumption which were not doing quite well in recent time, and the stock market penalized those, say, below expected operating performance. And the moment the operating performance come back, which we believe should come back in about 25, the thing should recover. So consumption is one of those area. Financials, I mentioned that currently uh, lending companies, whether it's a bank, NBFCs, more or less everybody is facing the similar challenge, like liquidity is tight. So cost of, say, borrowing has gone up and it's having some pressure on the NIM. And if the NIM pressure is there, the overall NII growth will be lower than the loan growth. And most of the companies are investing in future, some may be in tech, some may be in new verticals, etc., which is leading to higher cost to income ratios. So operating profit growth is even lower, but it's more about investing for future, and these things should also revert back in say about 25 onwards. It may be a challenge for a quarter or two, but the thing should come back because it's again a structural sector. Like any sound economy does require a sound financial system, so it's not either or. If we say consumption should do well, if we say infrastructure engineering should do well, then the financer of the same should also do well, because in our country everything is financed, right from say two-wheeler, four-wheeler, housing, consumer durable. So it's not either or, they have to come back.
Okay. The next question is, uh, we have seen the lowest ever PAT growth and operating growth in the footwear industries. What is your take on this, as we have taken Metro Brands in DRP portfolio? During last quarter, it generated negative PAT of minus 12.6%. Can you throw some light on Metro Brands and how we are seeing the stock in near future?
So in case of Metro, we have to factor in that the minus 12% growth is there because they are consolidating Cravatex. Like they acquired a business, Cravatex, which is having, say, Fila brand. And they acquired in December 22. This particular, say, acquisition consolidation itself is leading to close to 12 crore negative operating profit and close to 15 crore negative profit in the FY in Q3 FY24. So it's drag coming because of that consolidation. And our understanding is that it should normalize in FY25 and it start contributing to overall numbers in FY26 big time, because there is no issue related to gross margin or say operating margin at a brand level. It's more about you acquire something because you have the brand interest. At the same time, you are doing the cleansing over there. You are shutting down the existing stores and say liquidating the existing inventory. After that process is over, you will be launching the same thing through your own MBOs like Metro Mochi, at some point of time launching the EBOs, etc. So this acquisition is leading to this reported number looking like relatively weaker. And as I mentioned that CEO himself is mentioned that probably Q4 will be also on the similar line. The Q3 is there because FY24, they are facing the tough base. Like they had almost 50% top line growth in FY23. So it's leading to that high base, having implication for the reported number this year. And FY24 should work as a normal year. And in that scenario, that company can deliver high teen top line growth. And when these losses are no more there, we will like to believe the earning growth can be 20% plus in case of the macro. And demand challenges have been all across, like whether you are seeing the campus, but you name any company in the footwear industry. So discretionary as a sector did not do well in Q3. And more often than not, the reason highlighted was the same, that high base of last year is a drag, and FY24 should work as a normal year going forward. And if the base is normal, things coming back, then we will like to believe that footwear sector overall, and even so, Sematro should deliver stronger earning in years to come.
Okay. Next question is, how are you taking PSU as a segment at this current juncture? And is there any strategy to capture the growth of the sector in the portfolio, direct or indirect exposure?
So as I try to address this particular part as well during the presentation, that till November 23, we did not have any exposure over there. But we realize that there are certain pockets, whether it's a defense or say power, there are not many alternatives available. So if you think about defense, like it's not an episodic, say, expansion happening in that particular area. Looking at the geopolitical situation as of now, self-reliance is must. Many countries desire it, aspire for it, but only few can do it. And probably we are the lucky one that we have capability in this particular area. The issue is that most of the bigger company and best of the companies are in the PSU domain. So we decided to have some exposure in December, and we took Bharat Dynamics in the defense side. Second part I mentioned, like say power, like earlier probably not enough investment was done in the traditional, say, thermal power. And more, say, discussion were around, say, non-thermal alternative energy and so on. But we have realized that thermal power investment is must. So looking at the government, say, willingness to address this particular issue, this sector overall should do well. And we are playing the same sector through proxy. Like we have taken the position in REC. Looking at the need of the financing in the power sector, we will like to believe that this company can deliver close to 20% loan growth for medium term and can have 20%, close to 20% ROE. So quite good profitability, good loan growth, and still a reasonable valuation, close to 1.3, 1.4 price over book value over there. So earlier they used to be a challenge like say non-performing assets and so on. We have seen in last 2 3 years no incremental non-performing assets are there, and more so existing one are getting the resolution. So picture look relatively better. So credit cost is low, loan growth is high, and decent visibility is there. So we have taken some exposure towards the PSU through these two sub areas.
Raminder, are you there? I think Raminder has just got disconnected. We'll just wait for a moment. Raminder, can you hear us?
Yeah. Kuldeep, can you hear me? Yeah.
Yeah, please go ahead.
Okay. Next question
Sorry, Raminder, your voice is not clear.
is that,
Raminder, if you want to switch off your video and try. So Kuldeep, in the meanwhile, till Raminder joins back, so just to take one of the questions with regards to the Patanjali, which has just come up yesterday, if you just want to give some clarification on that, please.
So yesterday, a news came that Supreme Court has put some restriction on the advertisement on the Patanjali. I will like to say make a distinction that it has more to do with the Patanjali Ayurveda, which is the unlisted company, and Patanjali Port, which is a listed company, part of the portfolio has already done the exchange filing. That there is no restriction on any part of the business. So it's a business as usual. So just to clarify this particular part that whatever say news, articles, media has mentioned, it has more to do with say unlisted part and medicine business of the group. It has nothing to do with say FMCG or edible oil business, which is part of the listed entity over there.
Sure, sure. One of the questions which is coming is that we've seen some drag in the portfolio due to exposure to, say, Navin Fluorine, Page Industries, EU Small Finance Bank, HDFC Bank. So what are your views here? Because these stocks have not kind of delivered very strong returns over the last 2 years now. So your views there.
So whether it's a page or the financial sector, I try to club all those exposure as part of the overall sectoral issues over there. So as I mentioned, for about 24 and so, the earning was muted for page and probably it should start coming back in about 25 and so. So when the earning improve, then probably the stock return should also come back. And at any given point of time, we are always evaluating for the choices. If something appear better than say what we hold in the portfolios and any opportunity change, we do it. In fact, the page is not the part of the portfolio. It had been there. Like we have already changed the same in December. And second piece you mentioned about, say, I think financial sector. So financial sector, I already mentioned that challenges faced by the companies are quite universal. Like liquidity, the issue having some bearing on, say, the NIM, and probably it should normalize in the coming quarters. And if the loan growth remain resilient, like 15% plus, we will like to believe that the earning delivery should also improve. At the same time, the valuation have become quite compelling. And for most of the BFSI companies now, the valuation are almost 40%, 50% lower with what they used to be in the pre-COVID scenario. And probably this is the only sector where the valuation derating had been so sharp. So whenever the people have concern regarding the macro and the geopolitical, probably this is the first sector take a beating. Despite the point I highlighted, that it's not either or. If the economy is doing well, other sectors are doing well, the finances of the same should also do well.
Okay. Next question is the view on Vedant Fashion. The stock hasn't done well for the last couple of years. Recent PAT has also registered as 4.9% growth. Are we taking any action, and what is the size of opportunity, the growth from here on? It has negatively contributed to the overall returns of the portfolio. Can you please throw some light on the Vedant Fashions, why stock is not performing?
So we have taken the Vedant fashion exposure in mid-December 23 only. So it's hardly 2 months. And um, for the earning growth part, I have already explained that what is faced by Vedant is quite common across the discretionary consumer companies all across. So barring say jewelry, everything else had a issue. And jewelry, maybe it's more to do with the say a store in value. Like people believe that they are investing in future. There's a reason this category has behaved differently with say other categories over there. Otherwise, it was general or say universal slowdown across consumer subcategories. And I've already shown to this particular part that we believe it's more blip and the thing should come back in about 25 onwards. As far as Vedant, the overall opportunity size is being concerned, that say apparel market would be close to say 8 lakh crore, and within that ethnic wear is close to 2 lakh crore plus. Wedding and celebration is close to 1 lakh 30,000 crore. And this is the area where the Vedant is. And kicker is like even as of now, say branded would be 25 to 30%. So branded growth can be quite superior to overall, say, underlying growth in that particular category. So category is having a lot of tailwind. So we will like to believe that this company can have a retail area expansion of 15% plus CAGR for many years to come. And if the SSG is mid single digit or something, then we will like to believe that this company can deliver, say, at least high teen or close to 20% top line growth for the medium to long term. And they have a pretty strong margin. Like they make the reported basis close to 45% plus margin. And India suggested also they have close to 40% margin. So high gross margin, high EBITDA margin, high cash flow. And they are the leader in its own space. Like they have created, say, their own niche, whether it's a Manyavar brand, Mohe brand. And so the way we think about it, whatever is happening at the current juncture, partly due to say high base of FY23, partly due to say overall slowdown in recent time, and none of them is permanent. Like base will normalize in FY24, and as I mentioned that when the economy is growing, people have higher income. There is limit, like how much you can say use from the staples perspective. Uh, Only limited requirement is there for the basic needs. Anything over and above the same goes for say discretionary, and these are the company are focused in those areas, targeting mid premium segment and so on. So the earnings are bound to happen, and we will like to believe in FY25 onwards. It should be the business as usual, delivery as usual.
Okay, the next question is regarding the HDFC Limited and HDFC Bank's merger. Post merger, we have seen loan to deposit ratio is increased 89% in Q3 FY24 compared to 85% in Q1 FY24. How this impact the bank's revenue growth, and also names are also stressed as you have already shared while presenting. What's your view on the HDFC Bank in the long term?
So it's a very strong franchisee, and whenever the merger of this scale happen, obviously it takes time to do the integration part. And the issue is that it coincided with the overall challenges faced by the financial sector. The point I highlighted in terms of say tighter liquidity, and when you are bringing in housing in your port, etc., you have to raise a commensurate liability profile as well. And to do same, some benign, say, borrowing environment is required, which has not happened in recent quarters, and probably it may be a challenge for a quarter or two. And post that, the company should be able to deliver, say, better than say system level growth over there. So we will like to build that say close to mid-teen NI growth happening in the medium term uh, when the things normalize, and at least that much should translate into the bottom line as well.
Okay, the next question is APL Apollo, Varun Beverages, Patanjali, Polycab, KE are in the top holdings. Which sector are you gunning on, especially in DRP portfolio, and why? Though you have already said that in the last couple of months, a lot of changes have happened. Why the composition of top businesses is changing in majority of ASK's portfolio?
So, like we would look, Varun Beverages had been there almost since inception for 5.5 years in this particular portfolio, and it had been among the top position all across. So we keep on we constantly book the profit as and when the stock price move up. But as long as the company is delivering a strong earning on ground, uh, we want to be part of that story, and that's the reason this position had been there and had delivered quite solid returns. If we think about APL Apollo had been also similar sort of journey. Like we took the position in 2020, and they kept on delivering a strong earning. It translated into supernormal stock return. Recent times, Q3 was below expectation because the volume growth was relatively muted. From 2 year perspective, we will like to believe that the earnings should almost double. So the way we think about it, like even the best of the Indians do require the cooling off period, and probably they are going through that particular phase. And today, say the patience is relatively lower. So if the company is not delivering earning for quarter or two, the correction do happen. But at the same time, as long as our view is intact for say year, 2 year, 3 year, the things will come back from the stock return perspective as well. So APL Apollo had delivered both on say earning growth perspective as well as stock return perspective. Recent time, because the Q3 performance was muted, there was some challenge. Full year basis is still quite a strong result in FY24, and this journey should continue even in coming years. So the APL Apollo and say Varun had been relatively strong position. Patanjali, I already mentioned that this company is transforming from say commodity company to a pure FMCG company, and today, like this during this transition process, almost 30% top line is coming from the FMCG part, which is high growth, high margin business, and almost say you can say literally 100% of the profit are coming from there because edible oil business was facing a challenge. Even from say long-term perspective, more and more salience of say, FMCG piece will be there. And if it happens so, there will be a lot more predictability, visibility, cash flow. So it will be transformed company in say 3 to 5 years time frame. It will be pure FMCG company rather than commodity company. So FY24, we can say quite muted number. If we think about FY25, at least we expect 50%, 60% plus earning growth happening in FY25 because edible oil segment should also come back. After that, also on the FY25 base, we will like to believe that the earning growth delivery can be 15 to 20% for many years.
The next question is in DRP, there is no exposure to auto ancillaries. Auto has been doing well, especially electrical vehicles, both two-wheeler, four-wheeler, and passenger vehicles. Are you considering to add any stock in near future?
No, I have already mentioned that we have added C8 in December 23. So we have tried to address that white space.
Right. And then a brief outline on Polycab in DRP.
So Polycab is a leader in its own domain, like largest cable and wire company. This year they will be doing close to 17,000 crore revenue, more than 20% market share. So they have reached this level by doing certain things right. we know there had been some, say, concern related to, say, tax related issue faced by the company. As far as the official stand is being concerned, so Polycab has filed on the exchanges that they have not received any formal communication so far. And given the stature of the company and the position, and so we will like to believe that first the clarity should come. And as far as the fundamental is being concerned, today it's a proxy of the capex in this country. Like if we say whether it's a traditional capex happening in say industrial domain or the residential domain, the Polycab is a beneficiary of that particular part. Like almost 90% of the business is cable and wire. Within the cable and wire, the 70% is cable. So if it's an industrial capex, whether it's a say defense capex or say it's a alternative energy, any sort of capex, the cable is required. So they are the proxy in the area where the things are happening. We know these issues have cropped up, but the number being highlighted over there that close to 1,000 crore worth unaccounted revenue and so on. Today, it's very difficult to comment on like this 1,000 crore in context of what. So if it's a we take as a denominator as last 5 years. So Polycab had almost 60,000 crore revenue in last 5 years. If that is a base, then overall number look relatively not that material. But nonetheless, first the fact should come. The company's own say a filing should come, like what they have received in terms of communication. Then probably we will take a call accordingly. Otherwise, if somebody has reached to this level, they would have done many things right. That's the way we think about it.
Okay, the next question is, what is your view on the telecom sector? And if you could throw some light on the Bharti Airtel, which is part of the portfolio.
So telecom sector has done remarkably well. It's a, you can say, virtual duopoly. The only concern is related to the tariff hike. It is delayed because the last tariff hike happened almost 2 years back or so. We believe it should come in coming quarters and so. Even if the explicit tariffs have not risen, but because of the mix change, like 2G moving to 4G, higher postpaid, say, share, higher data consumption, all these things have provided, say, decent cushion in terms of ARPU growth. That's the reason, despite having, say, despite not having an explicit tariff hike, there was a strong improvement in ARPU. And once the explicit tariff hike also have, I believe there should be decent, say, operating profit growth should come into this particular sector. And please understand that it's a capex heavy sector, at least in past. So in terms of the overall outlay, the company has already mentioned that in FY24 till FY26, 3 years combined, they will be doing close to 75,000 crore capex. It's going to be front loaded. When you are investing in the initial periods, the free cash flows are relatively lower. Once the investments are being done, only the maintenance capex is required. Then the free cash flow grow quite supernormal manner. And this is something we expect from this particular sector, that a large part of the capex is already behind or should be done in FY25. After that, if the margins sustain the way they are and ARPU growth is happening, free cash flow growth should be much better than what probably we have seen in past. So it's going to be cash rich sector, and given the dynamics, this is the good place to be in.
So that was the last question. There are no more questions, in fact. Thank you so much, participant, for attending ASK Domestic Resurgence Portfolio quarterly update call. And this concludes our call. Thanks, Kuldeep. Yeah,
Thank you, everyone. Have a good day.
thanks.